This is a very large options expiration. Right now, it's the second largest expiration ever, but there's a ton of positions. Then every tweet he has a higher amount of volatility because of these giant positions. When we think about this move at 8 to 10% drawdown in the S&P 500, for example, and VIX spiking up to 30, to me, that's a big function of the fact that nobody was positioned for downside, right? And then there's this giant negative strike. There is a dealer or dealers that are short that strike. It's 40,000 puts, and that generates a massive amount of hedging flow. When you have this extreme of a sentiment in terms of humongous puts expiring, that oftentimes can be a local or short-term bottom in the market. VIX at 20 to 25 with this unknown situation of the tariffs, it's not a home run to short vol right now. But when VIX goes to 30, then you suddenly were able to bring some people out saying, okay, this is getting like a little bit crazy. The market makers are chasing to the upside and they're chasing back to the downside. And so, you get these overshoot rallies that just crash right down the next day.
So, Brent, I don't know if we can call this our first, maybe it's our first Markets in Turmoil episode of the OPEX Effect.
I think it warrants flames, that's for sure.
Well, I'm gonna throw it in there, because as you probably know this, the CNBC Markets in Turmoil thing is like the greatest contrarian indicator of all time.
It is, yeah.
So I'm gonna go ahead and just to give my value stock some hope here, I'm gonna go ahead and throw the slide in here, the Markets in Turmoil, just to see if it helps us.
Yeah, and I think you need something from me with flames. There you go. So you got.
I think you did one for your channel, right? Where you did that one time. I think I saw it.
I might have. Probably trying to make fun of somebody and that backfired on me, but anyway, here we are.
But anyway, getting to the content, we're doing this early this time because there's so much going on. Obviously, we've talked about the lack of volatility for a long time. That's certainly changed. We got a lot of events coming up this week, so we're actually putting this out on Saturday to get ahead of all of it. Plus, it prevents whatever changes in the market from changing while we're trying to get this thing out. So there's a lot to talk about this week.
There is, yeah. And part of the reason that I requested that we bump this up too is the VIX expiration's on Tuesday, which is a little unusual. Usually it's on Wednesday, and that's because there's Good Friday in April. So we need 30 days between VIX expiration and the next, the following month's SPX expiration. So there's a change in the expiration schedule. So we got to deliver this a little early.
Yeah. So before we get into it, because there's so much going on, and obviously I've been really interested, like watching these moves from the outside and seeing what's happening. I've been really interested to see what you're seeing behind the scenes in terms of what's going on. So we're going to get into all of that. But first, we just like to talk about, and we'll abbreviate it this time because we've got a lot to cover, but we like to talk about why this is important, why options flows are so important in the market.
Yeah, and we've done a couple of deep dives in recent, well, not all that recent. We've been doing this for a while, so it's probably about 6 or 8 months old now. Well, we cover why this options flows and kind of have an impact on the underlying market. And I'm going to go through this quickly again. If you're interested in the mechanics of this, please check out some of our previous episodes. But essentially the deal here is options volumes continue to expand. In fact, in January or February of this year, we had the record single day S&P options volume. So those volumes keep going up. If you have any doubt about the veracity or truth in the options market, just check out SIBO stock, which it seems unaffected by market weakness. And the way that this essentially works is we have all of these individual traders. They're buying, in this case, AMC or GameStop or S&P 0DT options or whatever it may be. And those orders all go to one of 17 or 18 different U.S. options exchanges. And 90% of the transactions that you and I trade in the options space, those are facilitated or traded against a market maker. You've heard the names: Citadel, Wolverine, Susquehanna, etc. And so they're required, in order to be a market maker, they have a deal with the exchanges. They have to constantly provide bids and offers on all of these options. So when we go trade, we're trading against them. Now, they can't say, hey, Jack, you're not allowed to buy AMC calls from me. They have to make a price. They don't have to make a good price, but they have to make a price. And so basically what happens is when we all decide to start buying and selling options, they accrue this exposure. So in this example, a bunch of us got together and we bought small lots of AMC calls, and you could see that added up to be 100,000 AMC calls. And just to give you an idea of the potential amount of shares that you have to buy in this situation, 100,000 calls at 50 delta. So 50 delta is kind of an at-the-money option. That equates to about 5 million shares of stock for the dealer or market maker to potentially have to buy. And they really don't know that exposure is coming until it hit their books, right? It's not like someone called them on the phone and said, hey, I want to buy these calls. What do you think? And they have a chance to get in front of that from a hedging perspective. In this case, the market makers have to sort of react. And that is a transmission mechanism, right? It's this hedging flow, the shares that are being bought and sold that we believe transmits options trades to movement in the underlying price.
And we really see that during times like this, right? When we're seeing significant volatility, that's where we're really seeing these flows have their impact.
That's right, and we try to present, or I should say, I try to present the evidence for that on a monthly basis here at expiration, and we think expiration has a particularly large impact on the market, and so we try to make that case here. We review what it looked like in the previous month to check our work, and then sort of make some projections going forward. But there's some pretty standard dynamics here, right? Based on total exposures, you could see in this chart here, there's some basic ways that market makers will have to hedge their positions, right? Either initial hedge, which we call a delta hedge, or an adjustment to that hedge, which is called a gamma hedge. And so the idea here being that just because a market maker is hedged in this case with their 5 million shares right here on this day, on this moment, at this price, as soon as either time changes or the underlying stock moves, they have to adjust that hedge, right? And that's the gamma hedge. That's the idea of gamma and why it's so important. And we're going to talk a lot about this delta and gamma dynamic over the course of the rest of this presentation. Sorry, go ahead, Jack.
I'm just curious how, in an environment dominated by macro like this, tariffs on, tariffs off, big news every day, how does that change? I mean, does it make it harder to do what you do in terms of thinking about how flows will influence the market because some crazy thing could just come up at any point?
You really got to zoom out. So that's a really interesting question here. And I wanted to bounce a little bit. We can touch on this again, but it's kind of funny when there's not much going on. You see short dated options volumes really flood into the market. So zero DTEs kind of rule the day. As soon as there's uncertainty, call it August of 2024 or the Silicon Valley bank crisis, or even right now, suddenly it becomes much more about longer dated positioning, and those shorter dated zero DT flows cause less issue, right? So essentially, when things are dull, I got to talk a lot more about what's supposed to happen today. And when things get kind of crazy like this, we got to zoom out a little bit and it becomes much more effective. And that makes sense because there's a lot more standard deviations in the move, right? So you got to kind of zoom out a little bit, from that perspective. But the options market to me is helping make these moves. It's making a lot of sense. And we'll present that here today. And the deal is that, people we've talked about this before, kind of Trump derangement syndrome as an investment strategy. And whether you like the guy or not, Trump derangement syndrome is not a great investment strategy. And I see that bleeding into how people think the market's going to react. And what's funny about that is that the options market doesn't have Trump derangement syndrome like a lot of some of the people that we know. And so you get a lot of truth in the price, right? If people aren't buying puts, then they really don't care. They're not putting their money where their mouth is in terms of, Trump bringing the end of the United States as we know it. And again, I'm not trying to say he's doing well or doing not. I'm just simply stating that usually, things get a little too carried away and too emotional, and you can find truth in prices, right? And so I think that is often the sentiment value, but there's a lot of positioning aspects in that and flow aspects in that. And we're going to present some of that today is why 5,500 is such key support. It's because people are selling puts below that level, for example, and they're making the statement that they don't think the S&P is going to go below that level, and that creates dealer hedging flows that are supportive of that price area, as an example.
So the idea in the expanding duration is if I want to hedge something like this, like major economic problems or something like that, buying zero DTE is doing nothing for me.
Yeah, you can't do it.
I need to go out further, and so that's why you're seeing it that way.
100%. This is called the known unknown market. So right now we all know Trump is allegedly negotiating tariffs. I don't know that it's the greatest way to negotiate via tweet, but look, we all know what's going on, right? We're trying to figure out if we're going to get tariff deals or not. And he set up this deadline of April 2nd, so we all know that there's this unknown. It's a known unknown of, is there a deal that's going to get done, or will this fall apart and become a full blown trade war? Who knows, right? You can't hedge that with a zero DTE, right? You got to buy 1, 2, 3, 6-month options to hedge that position out. It's the same thing with the bank crisis, right? When Silicon Valley Bank went down, we knew other banks were in trouble. We didn't know how the Fed would respond, if they would respond. We didn't know if other banks would go down. You can't hedge out the zero DT. You got to buy, 6-month option or a 3-month option to hedge yourself in that kind of situation.
So on this next slide, we're looking at the OPEX cycle, which we talk about every time, but it's probably good for you just to briefly explain it.
Yeah, and the deal is the biggest expirations are the third Friday of every month, and the idea is that positions build up into that third Friday, and with that, the associated hedges build up with those positions, and then once those options positions expire, the related hedges go away. And so we often see that this can lead to a dynamic or a change in the dynamic. So if we maybe have a strong market rally, we may peak out or top out, and that's it at OPEX, excuse me. And then if we're kind of crashing into expiration, we may start to bounce as options puts are removed and the hedging flows can turn from selling the market to buying the market back. So there's oftentimes a change in price and volatility around these options cycles. There's a bigger cycle around that, which is the quarterly expiration. So this is the March expiration, which is a quarterly expiration, which means that it's bigger than a normal expiration. And there's a lot more positions, a lot more sizable positions that are set to expire because bigger institutions tend to position on these quarterly expirations.
So it's one thing to talk about in theory what can happen here, but it's another thing to see it in practice. And we've always talked about 2020 as an example of these expirations and the impact they have. We don't even need to talk about 2020 right now because we can just talk about the last one.
That's right.
If you look at this chart here, the last it was the turning point right at the expiration. It pretty
VIX
much was,
expiration.
right?
Yeah, VIX expiration occurred 2 days before OPEX, and we were looking back saying, well, I think Nvidia is going to be the big turning point because that was a couple days after OPEX, but the high was right on VIX expiration day, and we came down right after that. Now, what's interesting is we're going to talk about this Condor trade that has been coming in the market, and that timed up with this sell-off here in February. But as you can see, almost like in the COVID crash, if you remember, the February OPEX really like released vol, and then suddenly is like, okay, tariffs and all this other bad news is actually going to come into fruition, and that seems to almost be what happened here. Obviously in COVID, it was like people were dying in the streets in China. We're like, why isn't the market crashing? OPEX hits and down we go. Same thing here, like tariffs and high PEs and all these other things, right? Suddenly you're like, okay, all that got priced in the matter of like 2 weeks. So, and on this point, this is a very large options expiration. Right now, it's the second largest expiration ever, but we still have a week to go. So these position sizes could change a little bit. But what's interesting, the takeaway here is this is S&P 500, so spiders and SPX. It is, as you can see, it's larger in terms of the delta value or the stock equivalent value set to expire. It's larger than all other options combined. So it's a massive complex. If you talk about NASDAQ, Russell, that's this little bucket up here at the top. So that's a much smaller options market. Then we have the ETF. So this is, XLF, et cetera, and then single stock. So the takeaway when you look at this is, okay, this is all very put weighted, meaning more put value in calls. That totally makes sense because the stock market's been crashing so much. And generally, again, when you have this extreme of a sentiment in terms of humongous puts expiring, that oftentimes can be a local or short-term bottom in the market.
And that put heavy thing is a function of A, people are buying puts, but B, also the puts are going up, right? So they're gaining value.
Put values are going right, because if you have a put that was struck at say 58 or 5900 in the S&P, and the S&P drops to 5600, then that put is almost worth full shares of stock, right? So that put is gaining in massive value. When that happens, the delta value goes up, right? And that increases the size of what you're seeing on your screen. So you're exactly right that when the market drops a lot and continues to go lower, put values expand. And then we have these put heavy expirations. And the idea is that the way that this has to get hedged out is with short futures or short stock positions from the market making community, right? And so when we approach expiration, they can start to buy those shares back. So if they're short, several thousand shares in Tesla or a million shares in Tesla, and they got to start to buy those back at expiration or right after expiration, then that should generate a bounce in Tesla, for example.
And is there any reason, is there any schedule in terms of how that happens? Like, is it when we get within a couple of days of expiration, if they're going to be buying, they buy? Is it once expiration clears? Is how do you think about that?
There's a lot of path dependency into expiration, right? When you have a situation like this where there's a lot of traders, like year long puts and the dealer's short, they have to very actively hedge that position. We call that negative gamma, which essentially means if the stock market's going down, they got to keep selling futures. If the stock market bounces and come up, they buy those futures back. And that exacerbates volatility, right? And there's a lot of premium in these put options and because there's so much volatility, right? So there's a decay function in here as well, a lot of theta decay in this situation, so that adds the dynamic. But ultimately, the dealers have this exposure on until expiration Friday, right? So at expiration Friday, they'll find out what their exposures are, and then stock is actually assigned, right? So there's this big assignment thing. So everything's not really cleared up until Saturday when positions are assigned. And then on kind of like Monday, we think there's a lot of shakeout to the final exposures and final adjustments. So, it's tricky trying to figure out the path at which this is hedged. In theory, if the market rallied 5% to 10% today, all these put values would go away and they wouldn't have anything else left to hedge, right? Because the put values would go to zero. So, there's this again, this path dependency. In the same idea, if people stop buying puts and all the puts go deep in the money, right? At some point, if I'm short one put, for example, and I'm short 100 shares, I have no more exposure. So there's nothing left for me to do. So that can oftentimes kind of alleviate downside volatility as well. It's like downside gets exhausted in that situation.
So in this next slide, we're seeing what you talked about, right? Which is this is put heavy, this expiration.
Yeah, and it just shows you this is the size or delta value of every expiration currently, and so you can see this is a much larger expiration than April. April's really quite small, as is all the other expirations out in time. So this is just meant to help show that, hey, this is really significant this next week for the options complex.
Is March usually one of the bigger quarterly ones, or does that just
Indeed.
happen to be this year?
Yeah, definitely. March is always one of the bigger ones. Obviously, SEP is huge. December is going to be the biggest, always the biggest at end of year position. But March, June, SEP, those quarterlies are always quite large. And that segues us to this idea of the JPMorgan collar trade, which expires at the end of this month. This number, 5565, is going to come up in our presentation. JPMorgan runs a hedge fund that is long equities, and every quarter they put a collar position on. We call this the JPMorgan collar trade. And it's relevant here because JPMorgan owns a put. This hedge fund owns a put at 5565. It is a massive position. So on your screen here is gamma by strike, and you can see this is all other strikes here, right? And then there's this giant negative strike. There is a dealer or dealers that are short that strike. It's 40,000 puts. And that generates a massive amount of hedging flow. That's what kind of gamma is showing you. And so this is a very significant level for the market into 331. That's the end of March. That's when this one expires. Now, before I mentioned that 5,500 is kind of a support area, these bars, if they're positive, that means dealers own those puts. We call that positive gamma areas, which means that dealers actually will be buying the dip in this zone. Oops, sorry about that. So the fact that there's more net positive gamma puts in this area suggests that dealers are buying dips into and below 5,500. And then the resistance area, the big resistance area we see into OPEX next week is 5,700, where dealers have, again, the dealers are long those calls, which means they'll be selling into that rally. So positive gamma hedging means they buy the dip and they sell the rip. And so that is setting up this really kind of like a field goal. We make that joke all the time. I think we were picking on Justin Tucker not long ago. In this case, the field goal is right there, right? 5,500 to 5,700 is this range that I think we're going to be stuck in through next week. Now, I understand that's a large range, but we've been swinging 100 points a day right over the course of this last week. So in the context of the volatility we've had, that's actually a fairly tight window, I think.
And we're going to talk about the JP Morgan thing, I know, a little bit later, but we typically don't go below that strike, right? That bottom strike.
Yeah, that's right. There's only one time since 2020 that we've closed below that, and that was March of 2020, that we closed below the JP Morgan long put strike. We visited this area only really twice since then. That was in March and June of 2022, and both times we closed just above it, 15 bips on one time and 40 bips above it on the other time. So, there is this pinning aspect to this trade, and I just said path dependency, I think twice already, so we'll just say it again. That how we head into this strike and how it gets hedged matters, but ultimately, I think what it revolves around is the idea that there's a large entity, a market maker or dealer entity that is incentivized to have this thing close out of the money, right? They want the market to close above that, and the hedging flows will just naturally sort of support the market closing, at or slightly above that strike is what the takeaway is here. So if you are a long-term investor and trying to listen at what I'm saying here, there's a whole bunch of options positions that support the market between 55.65 and 5,500, and that's lining up for a short-term bounce as we get out of March.
So on this next one, in terms of predicted volatility, we're about as far to the left as we've been, I think, when we've done these.
Right. And we were just talking about gamma. And so if you just add up the sum of all gamma in the S&P 500, we use that to create our gamma index. And the farther we are to the left of this gamma on this index, the more negative gamma we have, and that associates with more volatility in the S&P 500. So in this case, the y-axis is forward one-day S&P volatility. So obviously, when we have negative gamma, when we register large negative gamma before the market opens, the following session is very volatile. And we're at kind of peak volatility now. That's where this yellow arrow is. And, so we have the largest amount of negative gamma that we've seen in some time. And all this gamma is going to start to expire over the course of the next week, which should relieve this volatility that we're seeing in the market. So again, this just highlights the statistical correlation between gamma positioning and S&P movement.
So is this the opposite of what we usually see? So usually we've seen low volatility, and when the positions release, it's opened up a window for more volatility. Now it's going to go the other way, right? So we're going to see probably less volatility after the expiration.
You're exactly right. Yep. So
Okay.
normally we have a lot of call positions that kind of pins the market down, and then we remove those call positions, those positive gamma call positions, then volatility kind of expands, right? It's the cycle, the circle of life, the cycle of flows. Sorry, my kid's big into Lion King, so it's natural. Um,
If you knew how to use your mixer board there, we could put the music in right now.
I can still do it. Then we'll get doxxed on YouTube, I think. So we don't want that.
But yeah, I think that's true. I think you can only do like 7 seconds or something.
Yeah. And that point that you brought up is a great segue to this chart, which shows that there's some statistical evidence that says, look, we tend to flip after options expiration. So if the market rallies 2/3 of the time, we tend to sell off after. If we rally into OPEX, we'll sell off, or we'll mean revert, right? If we sell off into OPEX, we rally after. So that's 68% of the time we have that kind of performance flip around options expirations. And this one seems like, given how stretched these put values are and how much the market's been pulled down, it seems like it's a good bet that the market is going to have a nice rally based on everything that we're seeing.
So what are we seeing in this next slide? February OPEX pin released to JPMorgan.
Yeah, this chart was our founder's note on Tuesday. And essentially, what we're saying is, look, and we're going to talk about this momentarily again, but there's nothing to clear the volatility from the system because of the known unknown of the Trump tariffs. And he set this date, which I don't know what happens on that date. Maybe we get a deal, maybe we don't. Who knows?
Might get another date.
Might get another date. Second thing is, we have these giant positions. There's nothing to clear out those positions. And so that can't relieve the volatility either, right? So, if there's no positions in the market, then Trump can say whatever he wants and there's no reaction, right? If there's a ton of positions, then every tweet he has a higher amount of volatility because of these giant positions. And so when you look at this, what I basically said is this is about time and price. Time being options expirations. We start with VIX expiration, then we have FOMC, then we have OPEX. That's all, Tuesday, Thursday, Friday, or Tuesday, Wednesday, Thursday, Friday. And then we have the March quarterly expiration where that JPMorgan position goes away on 3/31. And then we have the tariff deadline on April 2nd. So all that happens in this yellow zone. And there's these giant options positions at that level that are very supportive of the market in this yellow box, which is 5,500 to 5,565. And again, this was in our founders zone on Tuesday. We tested and bounced that area on yesterday and today. And so, this is showing itself to be this kind of very supportive interim level, right? And the reason I say it's interim is because we're going to clear out these positions. If Trump says, hey, Canada, like we're sending our tanks up there or whatever people think is going to happen, then obviously the market could go lower. If he cuts a deal, then we're going to rip. Like, this floor, could go away is kind of a binary outcome of whatever we see out of this tariff rhetoric.
So as we look back to what we talked about last time, I think, and I'll not try to predict what you're going to say, but I think you're going to tell us that we're pretty much seeing the opposite of all of it right now. We said not much hedging going on, not much volatility. Like, it seems like we've probably reversed a lot of these things, but yeah, you can talk about what we talked about last time.
That's exactly right, Jack. I mean, the presentation title from February was "Where is the vol?" And we were talking about these crazy market moves, like in Nvidia. Nvidia had the largest market cap decline ever, and it was like the implied vol went down over that period. Same thing with Tesla. Tesla's down 30 to 50%, and implied vol went down over that period. That's not what you'd expect to see. Well, vol finally caught up, right? Now we're at the other extremes. Like, okay, now the vol is kind of too rich. So I just want to buzz through these slides. I think last presentation, I feel like we probably spent a little too much time on what happened in the past, but you'll pick up the theme quickly, right? This is volatility premium in February options expiration. The rub here is there's no volatility premium. The market was quite volatile, was moving around a lot, but there was no extra value in put positions. People were not scared, is what that is telling you, or people were not scared into Feb options expiration. Correlation, we did some really great work, if I can toot my own horn, about correlation into July of last year during, the August crash. We talked about how correlation fed that August 60 VIX crash. correlation was touching all-time lows or kind of plumbing that area into February options expiration. This was telling you that people didn't care about risk into February. They were not positioned for any downside whatsoever. Again, despite the fact that Nvidia and Tesla were actually getting pretty wonky into February options expiration. So again, people weren't positioned for downside. There was this interesting term structure bump for Nvidia earnings that turned out to be not quite as big a deal as VIX options expiration. This is another chart at the money S&P vol into February options expiration. It was a dud, right? There was just nothing going on in that volatility space. And again, this is surprising given how much volatility there was before, we got into March, right? The markets were weak back then. Put buyers, again, largely absent in the S&P positioning. As you can see here, there's an update of this slide. We'll show you in a few minutes, but the rub was there wasn't very much put positions. Skew, if people really wanted to buy out of the money puts because they thought the market was going to crash, you can make the case there was a little bit of put skew here. That's what this index is measuring, but it was far from, a panic situation. And again, just covering some of the huge losses, there was for example, this giant, largest ever market drawdown in Nvidia that was at the end of January. And so there's this ton of volatility in February, huge Tesla volatility. But again, I mentioned before that the at the money implied vol was not responsive. So just to recap on this, Nvidia had massive volatility, Tesla had massive volatility, and these red lines, which is that at the money implied vol, just wasn't responsive. It was really what this was all about into February was people had bet big on calls and getting long these stocks, and these call values imploded. Vol came down as the stocks came down. It was just very unusual and just highlighted this idea that nobody was positioned for downside. Talk about China, topping out. And again, we highlighted Nvidia earnings as a key driver. And what ended up happening here, if we check the way to look forward, is the options market, the VIX expiration, right, marked the high of the market. That was the high of the day. And then we just absolutely never turned back to the downside from that moment, from VIX expiration, really marked that critical high.
And to your credit, you were really talking about, if I take a theme from last time, it was there were a lot of red flags out there. And then, the potential for increased volatility was there when you added all this together into the equation.
Yeah. So much of the options market and volatility is like supply and demand, right? If everybody is on, short vol or betting that vol is not going anywhere and vol seems cheap, it's just like cheap houses. People come in and they start buying that, right? And then vol goes too high. It's just like housing prices will get too high. And, then that the housing market is about to crash, right? And it's the same thing. We've gone from scratching our head saying this doesn't make sense. It doesn't make sense. People are underpositioned to now, okay, vol is almost too expensive. It's too high given the moves that we're seeing. And so, we think about this move at 8 to 10% drawdown in the S&P 500, for example, and VIX spiking up to 30. To me, that's a big function of the fact that nobody was positioned for downside, right? So what happens is market starts to go down. Everyone rushes to the hedge themselves and prepare for volatility. They weren't ready for it. So you get just these exacerbated moves because everyone's kind of asleep at the wheel, for example.
So before we get into this one, which is what everyone wants to see here in terms of what you're seeing behind the scenes, I will take a little bit of a guess in terms of where we're going here, because I want to see if I've actually learned anything as I've listened to you this whole time. But I would think, based on our sort of our expiration 101 we've talked about, we've said whenever we get a big move in one direction into an expiration, and that expiration is very large, you've got the potential for a reversal. So I would think you have the potential for maybe a reversal of some of this downside. Now, I don't know if that's lasting or not, but that would be my guess based on what you've taught me so far.
Yeah, you're exactly right. And so it's kind of it's a weird spot, right? Because when the VIX gets to 25 to 30, which is roughly where we are right now, 25 area, right? What that's essentially telling you is that options are pretty expensive, and nobody wants to buy expensive stuff. Now, expensive is relative. If a nuke goes off and the VIX goes to 100, you've been like, oh crap, I should have bought options when the VIX is at 25, or put options. But most of the time, it's like that famous thing, shorting in the hole. It's like, I don't want to buy puts at VIX 25, right? I don't want to buy S&P 500 when the VIX is at 25, which is telling me that implied vol or options are expensive. That's why VIX 25 is relevant. So from an options perspective, you're like, I don't want to buy puts into this, so I'm not going to add pressure to this downside. VIX at 20 to 25 with this unknown situation of the tariffs, it's not a home run to short vol right now. But when VIX goes to 30, then you suddenly were able to bring some people out saying, okay, this is getting like a little bit crazy. I can sell vol from that perspective. The macro people arguably don't want to do anything right now because either, rate uncertainty, or they just want to go to bonds because bonds seem like a better deal because Trump's going to, walk rates down. I don't know. And then, I would pass the baton to you and say, from a valuation perspective, maybe in the last couple of days, some of the stocks have just got so pummeled that maybe there's some good value there. But it's like, what buyer have we triggered? You know what I mean? And until the VIX kind of got to 30, there wasn't like this obvious, volatility sellers that wanted to step up. So, really what it is we had to get these extremes to make somebody want to say, hey, this is an attractive dip to buy, right? Either the option sellers come out, they sell puts, either they sold puts they're long or they short sale puts, or you get valuation people to come up, or we clear out the unknowns and people can start to make express investment ideas because they have some idea what's going on with tariffs. So
Yeah, and to your point of valuations, although they don't matter that much in the short term, a lot of these tech names have been like killed, right? I mean,
So
for people who thought they were attractive values before, I mean, they're getting way better prices now. I mean, some of these names, I was just seeing it come across the other day, like some of the percent declines in these names, they're big.
yeah, yeah, 20, 30% plus in a lot of these things. And I was even just looking at like Target, which stock's down at 100. It was up at 150 not long ago. So even Costco's even down. So things are getting beat up. Everything except for the CBOE, which makes money both ways, right? You either buy your zero DTs on good days, or you buy your VIX calls when the market's falling apart, and they continue.
And as you pointed out, Costco's got no eggs and a lot of chickens, right?
I don't have any eggs. I I I I don't live near a Costco. My wife and I also feel like when I go, no one cares about the store. I'm going to tell them anyways, and so we never go because I always just feel like we end up buying a whole bunch of crap we don't need anyways, which is probably the same thing that. So it's like I'm going to save so much money by buying bulk, but then you buy a whole bunch of other crap. And I'm like, what's the net savings? Anyways, you couldn't find a parking spot at Costco, and then literally there was 0 eggs there, and then you walk over to the chicken aisle, and you're like, there's unlimited roasted chickens at $4.50, which just like kind of blew my mind. But apparently the deal is that the bird flu affects egg-laying hens, not the birds that are used to eat roasting chickens. I didn't know that was a different thing, but it is a different thing.
I
So
didn't either.
there's actually an economic reason for this.
The one way to find out is to tweet it, right? And then people will tell you.
The nonsense tweets continue to be my best performing tweets. I could provide you literally the key to the stock trading kingdom. I don't know that I have, but if I did, it would still get like no attention. But if you make a joke about particularly inappropriate joke, then those do grade A. So on that point, we're going to put flames on this thumbnail to see how it does.
Yeah, we'll get that done. So as we head into this next slide here, you're talking about that known unknowns that you referenced before.
Yeah, and this was just the sort of thing, and it was a theme that was in our notes recently, because you get some really major rallies during this bear market slide, right? Like today, S&P's up 2%, and everyone's okay. This is it, right? Like this is the moment to buy this dip. But my argument is like, look, there's nothing to clear the vol actually out of the system. There's nothing to remove this negative gamma from the system because we don't have options expiration. So if we got a deal and then everyone would buy the dip, then okay, then we have some extension in the rally. Like traders could sell vol down. The VIX could go back to 15-ish, but we don't have a deal. We don't know if a deal is coming. And so at options expiration, we're going to remove this negative gamma, right? Puts are negative gamma. We'll remove those. VIX calls are going to start to expire on Tuesday morning. So that's going to relieve some pressure there. And, the graph I showed you here is if you take the S&P 500 positions, so SPDRs and SPX, if you weight the call positions against the put positions, what you see is that all strikes within anywhere near where we're trading, the fact that this chart is negative is telling us that it's all put gamma. Put gamma is dominating the trading landscape here. It is a tremendous amount of positioning, and that just means that people, the market makers, are chasing to the upside and they're chasing back to the downside. And so, you get these overshoot rallies that just crash right down the next day. And then not only that, anytime a tweet or a headline comes out, there's a huge market reaction. We talked about this last time where people, DeepSeek news was out before the NVIDIA crash, right? But the NVIDIA crash was so big on the DeepSeek news that everyone thought DeepSeek was like the biggest thing that had ever happened in the history of the stock market, right? And the argument was like NVIDIA is so levered now that it overreacts, the stock overreacts to anything. So people look at the stock being down 15 to 20% and going, oh my God, DeepSeek is so important. Whereas if the stock went down 1%, people have been like, oh, DeepSeek doesn't mean anything. So I think that's true of some of these tweets now. It's like, the market reacts 1% down on some tweet and people goes, this tweet is so important. How can Trump, be doing this? And I'm not saying that he's right to handle things like this. I'm just saying that people assign too much importance to those tweets because the market goes down 1%. And the market's going down 1% because there's all this flow pushing the market down. As soon as it's like the market budges lower and then all this flow comes in to slam it, down 1%.
It's interesting because just going back to that 2% update thing, like it's ironic a little bit because if we actually wanted a lasting bottom from an option flows perspective, like we don't want the 2% rally right now, right? We probably want the market cascading downward into the expiration and we get a more lasting bottom rather than this. Is that right?
Yeah, it's like a slingshot. That's exactly right. Like the more you can jack vol up and like pull that down, not you jack, like jack is an increase. Then it is like that slingshot. So we're up 2% today. Easily fade that tomorrow back down to the 5,500 to 5,565, and that would make total sense to me, and it really wouldn't induce this much anxiety because I know there's these big positions that are swinging. And again, a lot of this stuff that's inducing these swings is gonna go away next week, and so that should start to relieve some of this like two-way volatility we have. Meaning that I think we'll get more of a directional rally, and then things will like cool off a little bit once we kind of get into early April.
So, so my favorite data indicator doesn't matter here on this next slide.
Yes, I'm here to talk poorly about all of your most important CPI, PPI, NFP. What other acronyms we got there? ISM. I'm here to say it doesn't matter. And the evidence for that is interesting. This is the VIX 1 day, VIX 1D it's called. It measures the 1 day VIX. And into CPI last week, it had the highest reading that we've had in a long time. As you can see there, it was showing about 32. I put that in red. And this was on CPI day. And so people thought that the CPI was, obviously very important based on the fact that the VIX for this date was very high, right? The 1 day VIX is very high. It says something important is going on today, or traders are expecting a lot of volatility. And so, the macro pundits will tell you that, okay, this means the CPI is really important. And at first I was like, okay, this is unusual. So what happened is our morning note, I quoted this, that the 0DT straddle is $83. That's extremely expensive for a 0DT straddle. You got to go back several years to kind of see a 0DT straddle that has that price. And to be clear, what a 0DT straddle is, if you take the option that is expiring today, take the at the money call and you take the at the money put and you add those prices together, you get a rough approximation for how much volatility the options market's pricing in. Does that make sense?
Yeah. So when I'm buying a straddle, I want volatility to go up, right? In either
That's right.
direction.
So if you buy an $83 straddle for the SPX index, if the market moves more than 83 handles on that day, you jack make money, Yahtzee. If it comes in less, then you lose whatever the difference is. So normally in that situation, on any given day, the S&P straddles something like $30, right? So this is really significant. And, this CPI didn't seem to be all that important, given the Trump tariff rhetoric. Like rates are actually coming down. It didn't line up as, like in late 2023, it kind of understood why the CPI was so important, right? It was like, when can we stop raising rates? And this one is like, it's a different situation. And so the reason I bring this up is because we've been tracking this trade called, we named this guy Captain Condor. And what he does is he trades a very large 0DT iron condor. Now, an iron condor is something like a straddle in that it is a bet on market volatility. And essentially what it is, when you sell a condor, you're betting that the market is going to stay within the strikes that you sell. So in this case, you had a situation where the condor trader was positioned with a giant position, 30,000 contracts on each side, which is very large for the S&P on a 0DT contract. And that position was $83 away from where the S&P 500 was trading. And the reason that's interesting to me is because that's a huge position. When you get to 30,000 0DT contracts, per spread, that's gonna, the market making dealer community, you would think would register that because it is so big. Think about it this way. We talk about the JPMorgan collar trade all the time, right? That's 40,000 contracts that's expiring at the end of the month. So, that puts it into signal. And the reason I bring this up is because it was fascinating that this trader puts on this trade the day before at 4 p.m. So it's technically a 1 DTE bet. So at 4:15 the day before expiration, right? So this would have been a Tuesday night. He puts on this bet that the market won't move more than, X percent on Wednesday. Does that make sense? Or on CPI
Yep.
day. And so the thing is you go, okay, there's this giant position, and the prices from where the market was trading to the strikes of the Condor, which you can see right here, was exactly $83. It was the same price as the straddle. So to me, it was this evidence that what the volatility was actually pricing in was this giant Condor position, and market makers were arguably pricing in such an expensive options straddle because of that positioning. It had nothing to do with the actual CPI itself. It had nothing to do with that data point. And if you weren't aware of that options positioning, then you may have misconstrued the importance of the CPI. Does that make sense?
It makes a lot of sense.
And so the interesting thing about this Condor trade is we see this, they have a really fascinating trading style where they run this martingale strategy. They put on a Condor trade, 0 DTE. If it's wrong, they double their size the next day. And every time they're wrong, they keep doubling that size. It's going to end well, right?
Sounds like a way to go bankrupt at the casino or something.
It's exactly that way. And so what happens is they keep laddering up. So we've seen now about 10 times over the last 6 months that this trade has gone over 10,000 contracts per side. At one point, it actually went 50,000 contracts in size. And interestingly, that was the Friday before the DeepSeek collapse. And the reason that I bring this up is because the day after these big Condor trades expire, when they expire, the day after, volatility seems to jump. There's a very high correlation there. Now, there's only, again, about 10 data points there, so I can't put a flag in the ground and have all the quants kind of code to this. But there is this idea that this giant Condor trade suppresses volatility, and then suddenly volatility expands. So what day was that, 50,000 lot Condor? Might you ask? It was this day right here. It was the same day as VIX expiration or OPEX and Friday OPEX. So it was right here was that giant 50,000 lot Condor trade, right? And then the next day, volatility dumps. So there's become this really interesting correlation. It just happened after this most recent trade as well, where, again, this short-term positioning may be having exacerbated effect in volatility.
Just an aside before we move on to the next slide, we don't know who Captain Condor is, right? This is an anonymous person.
It is an anonymous
entity or
person or
entity.
persons. Yeah.
Yeah.
There's a rumor that it's a kind of a retail trading community. And I don't want to say which one because I don't want to really draw attention to this because I don't know that it's a really healthy trading strategy. The reason is because, as we all know, if you play roulette and you run the martingale trading strategy, it works great until you're wrong 5-6 times in a row. Then suddenly you don't have enough bankroll to continue, or the casino manager comes out and says you're done. Which, you're talking about, when you're talking about 30,000 spreads, that's a, $6, $7, $8 million trade, right? And then if you double that, you're talking about, $10, $15 million trade. You double that. So the value can just, that this person's risking can accelerate very, very quickly. And this is the CPI day. And I just wanted to highlight this, CPI comes out here, there's this huge up reaction, then the market just does this giant gyration thing. And it's like, okay, I don't know if CPI was good or bad really at the end of the day, but if CPI was the most important thing ever, the market literally was unchanged and stayed exactly between these iron condor strikes that were so big in the market. And that $85 price proved to be way too expensive, right? Because the market closed essentially unchanged. So market makers, in theory, made a ton of money on that day, as did the Captain Condor on that day, because overall volatility was just very muted. And if that CPI was so important, you would have expected a much bigger directional change based on the outcome of that data print.
Is the Captain Condor, is he doing this consistently all the time? It just doesn't get big that often, or is he just doing it at certain times?
The trade started, as near as I could tell, in July of last year, and it when it's small, it starts about 2,500 lot contract size, which blends in with a lot of other positions. So sometimes it could be hard to finger point, or point to exactly where that trade is. But when they lose, they quickly double up, and as soon as you get over 5,000 size in the 0 DT space, your position is going to start to stand out a little bit, particularly if it's a Condor trade. Because a Condor trade is short a put spread and short a call spread. So you can line up these strikes pretty easily and you can figure out where the print is taking place. So again, it's been a little over 10 times that the position's gotten over 10,000 in size. And that's where there starts to be what seems like some, definable market movement. I will say for short-term traders, We watch these strikes because the market seems to react to them. So if you think about futures traders and stuff like that, they like to watch these positions because the market seems to react. But now there's this evidence that there's kind of this one DTE effect. Like, so once the big Condor trade goes away, volatility seems to expand the next day. There seems to be evidence that that is a true phenomenon. And the trade doesn't make sense for the strict reason that it's a negatively skewed payoff. The best I can figure, the best case scenario, you make $1.75 per contract when you are correct. You lose $3.25 when you are wrong, when your Condor trade is wrong. I think the price he gets actually tends to be a little bit worse than that. But let's just say, great, you make $1.75 to lose $3.25 when you're wrong. Well, his hit rate, as near as I can tell, is 60%. So you could do the math on that, Jack. You can realize that that's a terrible trading strategy unless you double down, right? And then when you double down, if you're right, you recoup your gains and then some the next day. But of course, like all other martingale betting strategies at the casino, there's going to be this chain of events where you're wrong 4, 5, 6 times and you run out of bankroll, and then this entire trading strategy just nukes you, right? And unfortunately, in those situations, we all know the rules of the game change. A margin rate may change with your broker or whatever it may be, and that's why you can't trade. It's just like the Hunt brothers. They had the silver market cornered, and then they said, "Well, guess what? You're no longer allowed to was it buy or sell silver? I forget which one blew them up." And and then the Hunt brothers went belly up. The silver squeeze. I guess I'm older than you, Jack, so you don't know that story.
Yeah, you're right about the same.
You remember?
So I do know that, but not as well as you do. But yeah, on this next slide, you're talking about of the many things that have changed since our last episode. This is another one, correlation.
Right. So this was in our previous what happened into February. Correlation was really low. In this case, correlation spiked. What does correlation spiking means? It means that suddenly all stocks are for sale. So in a very bullish market like we had in July of last year or even into February of this year, people are in stocks, right? But then it becomes, hey, what stock do I buy? Oh, Nvidia is going to crush it, or it's Tesla, or it's GameStop, or it's MicroStrategy. Like, people are trying to bet on which stock they need to own to outperform the market. When the market crashes, all stocks go down, and the conversation starts to be, do I own stocks at all, or should I be over there in bonds or in cash or in gold or whatever it may be, right? So that, correlation spiking is evidence of generally the market crashing. And like other barometers, this is just an index. So, you can start to see we've reached the area of the August sell-off where correlation spiked. And we're kind of in that area of 2022, where all of 2022 was, again, do I own bonds or do I own stocks? Like, which way am I going here? Or do I just sit in cash? Or I guess you didn't really want to own bonds in 2022 either. You wanted to own savings bonds. That was it, right? Wasn't that what everyone was into?
Yeah, I think it was.
I think it was savings bonds.
I never was, but I guess.
So, the point is like, people viewed equities as an asset class. Am I in or out? Whereas most of the time people are like, I own stocks. Which one do I own to outperform the market? So when, this correlation is a risk off sentiment, again, from these lows. The vol premium now, very high. As you can see here on this chart, this is the spider implied vol premium, which is just showing you that the spread between the red and blue lines is essentially the vol premium. And that has obviously expanded quite a bit from where we were in February down in this kind of area. And you start to see that this is the August crash, right, where VIX went over 60. And, you can see you start to get this really big premium. That premium brings out the options sellers, right? They start to go, okay, either if I own puts, it's a great time to sell them. I want to cash in when this premium is high, or I may want to short puts because there's enough juice to make this bet, right? Even if there is this risk of Trump, escalating the tariff stuff, statistically speaking, I can make the case that this is a nice place for me to sell puts or short them, or short volatility, because the juice could be worth the squeeze in that situation, right?
From last episode, this premium had been very low for a long time, right? Before this.
Yeah, and if you just compare the spread generally between this, you can see it ebbs and flows. But February, we're over here where that premium was really quite tight. And again, this is just a kind of a rough approximation of that idea. But when you get implied vol really energized and jumping, like the VIX hits 60, or 30 in this case, that's generally telling you that, okay, the vol premium is getting pretty high because traders are starting to buy put options. They're starting to get worried about the downside. And generally, again, that extra premium starts to make short volatility strategies possibly more interesting.
So now in this next slide, we're getting at potential YouTube titles for Jack here with the vol waterfall.
The vol waterfall,
I like it.
I still like quantum computing. That one never made anything, so we'll try the vol waterfall.
That one was great. Yeah, I wish that would have worked because that was phenomenal.
Yeah. But the idea here is realized volatility has increased quite a bit. And so realized vol, in this case, the green line is 1 month realized vol. So it's like how much has the market been moving over the last 30 days on an annualized basis? It's about 17, 18, 19% in that area. 5-day realized vol is a red line, and you can see we're up closer to 22. Historically, if you add 3.5 points to that green line, you get the fair value for the VIX. So the green line's right about 18, 19 right now. You add 3, let's call it 4 points to that. You got VIX 22. So VIX 22 is fair value based on how much the stock market's been moving. Hopefully that's clear. And so the idea is that if realized vol starts to come down, right, i.e. the stock market just stops whipping around so much, then as that realized vol comes down, then implied vol can come down as well, right? The VIX can drop because fair value in the VIX is lower. It makes sense because if the market is moving less, then you don't need to price in so much volatility in the future, and that's really what this is. Realized vol it's hard for the market to sustain this level of realized volatility. Of course, if Trump starts trade war, then that goes out the window. But just generally speaking, you're getting to this realized vol level of roughly 20. The S&P, that's 1 to 2% moves on a daily basis. That generally is not a sustainable amount of movement.
And also, just to give you a little credit before we move on here, as much as quantum computing did not work as a YouTube title, coiled for big moves, which I took out of your last one, actually worked exceptionally well. So our last episode had a very good click-through rate on coiled for big moves.
All right. I like it.
So I'll find something in here that works.
I think that, yeah, you just keep throwing shit at the wall and then something sticks, I guess.
It is pretty much what it is.
We'll
It's
throw
a
more
lot of
shit.
testing back and forth.
Yeah.
But so this next one you're looking at, and this is something that I think a lot of people don't understand what it is, but so you're looking at fixed strike vol in this next one, right?
Yes. It's a critical dynamic in this type of environment because so many people base their, volatility sentiment or market sentiment off the VIX. And we've talked about this several times in the past where the VIX is a function of the prices of S&P 500 options. And so the deal is that naturally options that are farther out of the money, so like put values and put options, farther down, they have naturally higher implied vols than call options in the S&P 500, right? There's this skew that is like a ramp. And so when you calculate the VIX, right, you're taking all those options prices around basically where the S&P is trading. You essentially sum those implied vols up, and that calculates the VIX. Well, if the market goes down, let's say 2%, then the VIX is taking into the equation options with higher implied vols, just naturally, right? Because there's that skew. Same thing, if the market rallies, well, those calls already had a lower implied vol, so now the VIX is just calculating lower implied vols off of the natural skew of options prices. So what I'm essentially telling you is oftentimes the VIX is just simply an expression of the S&P going up or down. It's not actually reflecting a volatility demand or demand for options. I'm praying that explanation.
No, that makes a lot of sense.
Okay.
Yeah, and I think a lot of people get that wrong, right? A lot of people look at the VIX and maybe draw the wrong conclusions specifically during these big moves.
That's exactly right. If the VIX has to go up in excess of that S&P vol or down as an expression of, okay, volatility prices, implied volatility actually went up or down. So you have to that's why we look at fixed strike vol, because what fixed strike vol is showing you is what is the actual implied volatility change at each strike in the S&P 500. And so what I did here is I compared fixed strike vol. So, what is the vol at the 5,500 puts, for example, from last Friday to today, right? And in the short term, there's some noise, right? Because, dates creep up on us. But if you look out at May or even July expirations here, what you can see is that fixed strike vol is down across the board. And those of you, I don't know if some people just listen to this, how you could possibly miss the slide decks is beyond me, but we're down about 1 to 2 vol points over last week. The S&P made fresh lows, in this during this time frame. But the fact that fixed strike vol is down, even though the market is actually a little bit lower, is telling you that implied volatility is falling, right? So the VIX is actually going to be flat to up during this period, which most people would tell you means that there's more fear because the fear index is higher. But when you actually look at fixed strike vol, the fact that fixed strike vol is down is telling you that implied vols are coming down, that the risk that's being priced in the market is deflating, it's coming off. And unless you look at this fixed strike vol lens, then you would not understand or uncover that phenomenon.
And for people like me, there's nothing publicly available about this, right? You're not going to, unless you subscribe to something like Spot Gamma or something else, you're not going to find this data anywhere, right?
Yeah. I I'm sure there's some institutional risk systems out there. One of the reasons we built this because it wasn't available anywhere else. I don't say that as a plug. I legitimately don't know of another a good source for this. And we built it because it provides such valuable information. I think a lot of times you'll see Chris Adil and the real vol guys talking about fixed strike vol, and it's a shame because there is really some great information embedded in there, right? You don't get kind of like tricked or you don't misread vol indexes, for example, when you're able to monitor fixed strike volatility.
So on this next slide, we're again reversing last time. We've gone from puts too cheap to puts too rich, maybe.
Yeah, and there's a lot of noise in this chart, but I left it this way. I just chose any options with a ADV over 50,000 calls just to thin it out a little bit, thin out the plots. And so IV rank, 1 is the highest implied vol over the last year. So where are we ranked? The stats go back a year. So if you're near a 1, you're at a really high implied vol. And then skew rank, which is the y-axis, if you're at a 0, that means put prices relative to vols or relative to calls are at highs, right? So we're huge put prices and very high volatility is kind of the sum of all of this chart, right? When you have a very bullish environment, you would have most of the plots up here at the top of the chart because call prices would be very high relative to puts. So when you look at this and you're going back to last year, this is pricing in or includes the dates of the August volatility crash and the FOMC kind of crash that we had in December, and then of course the deep sea crash and stuff. So the fact that a lot of these names are at the bottom of this chart, which tells us that put prices are high versus the ranking over the last year, and then implied vol is also pretty high for most of these names. It's telling you that again, this is all very stretched. When I look at this, I go, I can't buy puts in any of these names, or it just seems like a real disincentive for me to want to buy puts in any of these names because it's always already so expensive. Now, do I want to sell those puts? Maybe, maybe not. That's a different discussion. I certainly want to buy them. It's just, again, this idea that things are too, the downside is too stretched. If we rally a little bit, you relieve some of this pressure, then maybe we could go back down. But right now it's a stalemate because if you own puts, maybe you're okay holding those, but you definitely want to short, you definitely want to buy them at this point, right? Shorting in the hole essentially is what this is showing us. And the sector themes are also pretty interesting. You see stuff like, Apple, Walmart, JPMorgan, Nike. This is not just the deep seek reaction. This is actually some of the bigger, more macro, defensive names or retail names, stuff that is generally not as volatile that's getting pretty beat up. Airlines in here. Another one that I thought was really interesting that's showing up here is GDX and actually gold, right? Gold hit all-time highs yesterday or today. And there is no evidence at all that the call buyers are really coming in a heavy way into gold. If you remember recently, we talked about how rich call skews were in the Chinese stocks, for example, off that huge rally. And that proved to be a stalling point, an area where these Chinese stocks have stopped out because the call prices got too rich. Gold right now does not show any signs of being too rich in terms of call prices, which is very interesting given that it just hit new all-time highs. So I'm kind of flagging this as one that we're going to check in next month and really see what happened with gold prices as the idea being that once these call buyers kind of wake up, that could really kind of accelerate gains. And so that's something I'm certainly watching. And if nothing else, if you're interested in kind of trying to ride that gold train, I don't know which way gold is going, but I can tell you that call prices seem pretty reasonable if you want to bet that gold's going to go higher. And I say that because you can see here on the skew rank, GLD, which is the gold ETF, it's at a 0.2. That's telling you that actually people, if anything, are more into puts than calls at this point, which is a little bit unique.
So on this next slide, we've got one of the reasons we're reporting early here, which is there's a lot of events coming up.
Right. Next week we have VIX expiration Tuesday. There's a big FOMC, then a huge options expiration on Friday, and then you got another roughly about a week, and then on 3/31 is where this JPMorgan call expires. We'll talk about that in a second, and then I believe that the next day, it might be 2 days later. I forget whether. I think 3/31 is a Monday, actually. So it's 2 days later is the tariff deadline. Who knows what the heck that means? But there is what looks like an implied vol bump, which I think will get more kind of distinguished or pronounced as we get closer to that date. But the market definitely seems to be pricing in some volatility around that date, which makes sense. So again, the path here is between these positions all clearing out. If the Fed particularly is just kind of like a nothing burger or doesn't shake the volatility tree too much, then you would expect implied vol to come down a little bit, right? The positioning should relieve some of the volatility, but we can't quite kick it into full gear until we get like a tariff all clear, which means that I think we could have a mild rally after this, but not a full, risk on rally, unless Fed could be very dovish maybe, and that would kind of light things up. But the real point here is that the volatility that we're seeing should start to become really muted, I think, into the end of the month. Another sector I just want to toss this in for extra credit. Danny Kirsch is a great follow on Twitter there. An institutional sales trader. He pointed out that HYG put volumes, which is the high yield put ETF or high yield bond ETF, excuse me, had just these record put volumes. Same thing with LQD. And what's interesting about these record put volumes is I'm invoking the fixed strike matrix again here. And what you see is the red is telling us that statistically implied vols are down into the downside in HYG, which would infer that people are actually selling the puts that they owned, right? Because if you're selling puts, that's going to make the implied vol go down. Implied vol is just a way of saying options prices. So the fact that these options prices are so depressed is telling us that there's big put sellers in HYG, which is, again, these credit ETFs. We're seeing similar flow in TLT, big put flow, as well as in LQD, which is just as kind of evidence, again, that maybe we've hit this short-term bottom. HYG obviously has been, beat up pretty good over the last couple of days and weeks. And so, this seems to be some people monetizing or selling some puts that they owned. Another just one of these things that maybe we're getting this kind of risk on sentiment starting to approach.
Yeah, and this next one we're getting in the JPMorgan collar trade, which could be I've learned when we get near those strikes, that's where it becomes more important.
Right. And so this is going to be, billions of dollars worth of gamma, talking $5 to $10 billion worth of gamma. So what does that mean? That means there's $5 to $10 billion worth of hedging flow tied to this strike as we get into expiration. And that's persistent hedging flow. It's not like it's on right now and then it goes away like, hey, I bought $5 billion worth of Apple and I'm done. It's like $5 billion need to buy here, $5 billion need to sell here, like all day long, right? Every day. And so this is our trace map. And what it's essentially showing you is gamma by strike. And the reason I highlight this is because you can see the gamma for this 55, 65 is just really big. Gamma increases as we get closer to expiration. So that strike should continue to grow in size and importance. And it's been a real key level already. I'm honestly tired of saying JPMorgan 55, 65 already, and we still got another 2 weeks to go. But this is the market performance over the last 5 days, and that black line is the 55, 65 strike. So, there are these hedging flows that are only going to increase in size around this strike. Everyone also is kind of aware that this trade is in the market, which I think naturally makes it this kind of support and resistance level, kind of like a moving average in that respect. And so, it is something to watch. On 3/31, they will roll their JPMorgan collar position to it's June is the next quarter. I had to think about that for a second. So at the end of June, they will restrike these positions, which is always kind of a big trading day on that last day of March. And so, the kind of rub here is, again, that there are these big supportive put positions at 5,500 into next Friday's expiration, but this position will still be there to tether the market in a lot of ways into the end of March. And so, you kind of need to be aware of that dynamic, and look, if the Fed is dovish and there's some good news that comes out about tariffs before the end of the month, then nothing says that we can't just rally above this strike. I do think, though, that it's hard for the market to push below this strike and close below it onto expiration. And so, it's just another supportive indicator, a positioning indicator that's in the market until the end of March.
Would there be something if we did break through it? Would it like serve to exacerbate the downside? So if we did ever get through it, would it make it more likely we'd go down more?
That in theory that is correct. What seems to be happening to me, though, is that the dealers hedge it out, right? They have other positions that offset some of the risk. And so I'm going back to this other slide quickly because you see all of these put positions, right? So this is a JPMorgan strike, that same one that I highlighted in red before. It's this big strike here. There's all these other smaller but positive gamma strikes below it, which are offsetting the risk for the strike below, right? So if we net out all the exposure here to the downside, there's actually not that much exposure. And you can see because this red line goes up, that's what that red line is telling you. That's kind of like the sum of gamma as we go down in price. So this thing seems to be pretty well hedged out. And, there's some short futures that are tied to it as well. And there'll be, all else equal, they're going to buy some of those futures back as the position decays into 331. Now, this positioning is going to change quite a bit over the next week, right? With the options expiration next Friday. But in theory, Jack, you are correct. But I think when you actually looked at positioning, there's a lot that's offsetting the downside risk to this specific put, and it makes you kind of wonder why they bother doing this anyways, because it doesn't ever seem to pay out, and they short this call to the upside, and that call oftentimes gets blown through to the upside. So it just seems to be a real performance drag for the fund. But people like the yield, I guess, or whatever. I don't know.
So as we wrap up here, Brent, I got to say, like our first Markets and Turmoil episode was a lot of fun.
Good. I'm
More
glad you
action
liked
than we
it.
usually have on the OPEX effect.
Yeah, I'm looking forward to seeing how the flames return and if people get a lot more excited.
I can't bring myself to put the flames on the actual YouTube cover because I hate the channels that do that kind of stuff. But I will put it in the episode somewhere. There'll be a picture of you with the flames somewhere inside the episode.
Yeah. If that doesn't work, we could start doing like shirtless workout videos. Maybe that'll get.
I don't know if anybody wants to see that, but I guess
I'll draw the views.
That's a good note to wrap up on. Thank you everyone for joining us, and we'll see you next time.
Thanks so much, Jag. It was fun, and we'll see you next month.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Validia Capital Management. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.